Welcome to Value Investor TV podcast. This is the podcast that helps you grow your wealth and become financially independent. My name is Becco and my partner, Hari. Okay, in this episode 31, we're going to talk about discounted cash flow. In the previous episode, we talked about price to book, sum of parts, and price to cash. And these are measurements that we talked about in valuation ratio. And this kind of cash flow topic that we're going to cover in this episode, that also we talked about in the valuation ratio. So if you want a quick overview of all the valuation ratios, check out that episode. And if you want to understand these different valuation ratios that I listed in more detail, check out our previous episodes. Okay, so let's dive into the discounted cash flow. Let's talk about what it is first. Actually, before we do that, let's talk about why is it important to use free cash flow. I think we talked about this in price to earnings and price to free cash flow. But why is it important to use free cash flow, and why is it more of an accurate measurement of valuation? Again, let's go back to kind of the definition of business, why businesses exist, and why, as shareholders, as owners of the business, care about free cash flow. Because free cash flow is what owners get at the end of a certain period. For example, at the end of a year, we get all the money in our bank. What do we actually have? What is the cash on the book? Because free cash flow reflects that. It reflects the cash that is available for owners to use for three different things. You have this free cash at the end. You could use it to invest it back into the business. You could pay out the dividend, or you could purchase buy back your own stocks. But effectively, the main thing I want to convey to you guys is that free cash flow is a better measurement than earnings, or price to book or price to earnings or price to sales, stuff like that. All these different measurements, because free cash flow really is about what is left at the end. What is left at the end for the owners. So again, I just wanted to highlight that before we talk about the definition of discounted cash flow. Yep. The importance of free cash flow. Okay, let's move on to the definition. So discounted cash flow, DCF, is also called. DCF analysis finds the present value of expected future cash flows using a discount rate. Again, I want to highlight this again. DCF analysis finds the present value of expected future cash flows using a discount value. There's a lot to unpack there, but I want to talk about the time value of money before we actually go into a detail of this. So time value of money is basically a concept that money, $1 now, is worth more now currently than $1 in the future. So that's the basic gist of time value of money. And discounted cash flow takes that into account. And so it projects, so there are many assumptions that we have to make in order to conduct discounted cash flow analysis. But effectively, we are projecting cash flow into the future, and that cash flow, we discount that back into present value and get a valuation of the company using that. And so let's dive into kind of the more detail. If you have anything else to add here with this discounted cash flow, Hari.
Yeah, I mean, I think one of the things that you said there was present value of the money that you had. So that's the free cash flow that they get per year. And then the discount rate, right? So the discount rate is ideally it's if a lot of this sounds very kind of mathematical, academic, then you're right. It is a mathematical kind of measurement of, and theoretical in a lot of ways.
Yeah.
What the discount rate though is telling you is, what if I gave you $1 a year from now? Or if, let's say I could give you $1 today, or I could give you some amount of money in a year from now. How much money would it be a year from now for you to not take the money today versus taking it a year from now, right? So you are indifferent to how much money you get today versus next year, right? And the idea is that if the way that you would measure that is, what are the other places I could put that dollar today versus next year to make this worthwhile, right? And that's why the discount rate is such a interesting concept, right? Is that if you use the safest ratio, like which is the treasury bill, right? I could put my money in a treasury bill today, and I would have 5% more of my money a year from now, right? If assuming that it had a 5% yield.
Yeah.
Or you could give me the money today, and I could take that money and invest it in something else, right? I could go and invest it in a stock and get a 15% return this year, right? So the idea that you're really trying to anchor to with this concept is, what am I going to invest in? Because this is my opportunity cost of investing. If I take this money and I put it somewhere else versus putting it into my versus putting it into a safe investment like a treasury bill or the S&P 500, which I know will give me between 5 and 8%, then it's not worth my while to put my money into something that's going to get me less than that, right? And so that's why you want to, what you're trying to measure with these present and future cash flows is taking all of that money that you have created in the future, discounting it enough that to say that I wouldn't be able to put this elsewhere, and then getting a number from that, right? And so what you will find after all of this is there's a current share price, and then there's a share price or market cap that this will generate for you, and then you have to decide, if that's worth your estimate, right?
I think I think I did a poor job actually in the beginning talking about what it is. So let me just reiterate that point. So discounted cash flow is another valuation measurement that people use to assign intrinsic value of the company. And discounted cash flow is good because we're using free cash flow, and that I talked about earlier. But the way you do this is instead of taking price to earnings or price to book or price to sales, all these measurements are really snapshot in time, right? This is yearly performance. You can average the earnings, you can average the sales, you could average the book over multiple years to smooth things out. But effectively, this is only a snapshot in time. Whereas discounted cash flow is a little bit more than that. It takes into account multiple years of free cash flow. And as I said earlier, you estimate, you predict future free cash flow into the future, and you add it all up to the present value.
Right.
We'll talk about the exact formula in the next episode, but I want to just lay it out there that discounted cash flow, another benefit, a big important benefit of using discounted cash flow is you're making assessments, making predictions into the future.
Yep.
And as I said, because you're making predictions into the future, that's where you're making all these assumptions because you have to project how this business is going to do in the future. That can be a positive thing if you do it right, but it could also be detriment to your valuation. So I just wanted to throw that out there before we move on to the pros and cons of discounted cash flow. Okay, let's dive into that then. So Hari, take us through why people should use discounted cash flow, and even if they use it, what are some of the downfalls of using discounted cash flow?
Well, so the value of a business is how much profit it can generate from now till eternity, right? That's discounted at some appropriate rate. Yeah. And it's literally what Buffett has called how you value a business, right?
The judgment day, he calls it.
Yeah, till judgment day, right? So so when you start measuring what a business is worth, what you're really saying is, if I can't generate a profit, and if I can't take money away from the business and still have it function, is the business worthless? Well, not necessarily worthless, but it is something that is hard to measure, right? So that immediately limits you to businesses that actually generate positive free cash flow on a consistent basis, right? And so there's, that eliminates like 60 or 70% of business. I don't know, there's some large percentage of businesses, right? But it is the most accurate way of knowing what something is worth, right? So if you can actually use this metric to measure, the value of a business, it's the most accurate way of measuring that business, right? Because then you can actually say anchor to something legitimate, right? I mean, book value, earnings, all of those things are difficult because at the end of the day, book value is relying on if you have to liquidate a business. I mean, imagine if you had to sell something very quickly, you're not going to be able to get the best price for it, right?
Yep.
And so in a fire sale, liquidation is not going to be the best price that you're going to find.
Yep.
The same is true, but this is what this is actually measuring is the cash generating potential of the business, right? And so you're now being able to measure that and compare it against other investment opportunities. And what you may find is that none of the opportunities actually are able to generate a significant, so I think, 3 months ago, it's December 2018, in September, the stock market peaked. You would probably have trouble finding investments when the stock market is peaking because, the investor sentiment is very high, and so they don't price things rationally at that point. The sky's the limit, and all of those things that they say. So DCF is kind of an anchor point to measure something on simple measurements.
Yeah. Yeah, so it's really the closest measurement to the the company's intrinsic value because again, a company is there to exist. It exists because the purpose of it is to extract cash out of the business. That's the purpose of the business, and that's why DCF kind of gets to the closest estimate of stock's intrinsic value.
Yep.
Yeah. And again, some of the pros, like we talked about, it uses free cash. It's not really influenced by the short term because we're projecting way out in the future. And also because, like Hari said, if you're able to predict with high confidence the future generating potential of the business, with high confidence, then DCF is a great way to do that.
Yeah, and so that goes back to our discussion earlier about understanding the business. It is a lot easier to predict Wrigley Gum's future cash flows than it is, say, Facebook. Even though Facebook is a much more valuable company today, I don't know for sure with certainty what Facebook will look like in 5 years and 10 years, right? I mean, it may be totally the same, and you may be able to understand that. Me personally, I can't say that I know what a social media company is going to be like in 5 or 10 years because they haven't had a very significant operating history, right? And technology tends to get disrupted. So all of these thought processes are why we had that checklist, right? The checklist is to tell you, can I reliably predict cash flows? Can I reliably predict what this business is going to be like in 5 or 10 years? Is there a moat that will protect my earning potential? That kind of stuff. And, if you think about it that way, then what you start realizing is some businesses are a lot shakier than others because they operate on, a foundation. Like, for example, let's talk about like a company like GoPro, right? So GoPro has, was one of the first companies to make action cameras that, you could attach to your helmet and do all kinds of crazy stunts and then upload to YouTube and things like that. Great, cameras, all of that stuff are all great. But it's not exactly a a moat that can protect them, right? And so, their cash flow, they may be very profitable. I've never actually looked at their business. But it's hard to see what that's going to be in 5 or 10 years. I mean, at that point, has everyone bought a camera that they're going to do?
Right.
And GoPro may have other lines of business that may protect them, right? So what you're really looking for in this space is what do they do and how is that going to stay relevant in the next 5 to 10 years?
Yeah.
So.
Yeah, and also, and we can kind of talk about this later also, but this is very much assumption-driven, assumption-based calculation. So, like Hari said, if you're able to predict with high confidence, then by all means. But if you can't, this could really, screw you over.
Yeah, which is why you need to take this with a grain of salt and not always use it as the be very conservative in your estimates.
Yeah. Yeah, exactly. And that kind of is a good segue into the con. And we touched on some of these points. So DCF valuation, some of the cons. So for example, like assumptions, for example, if you're making all these assumptions based on, making it out of thin air, for example, or even if you're anchoring on some point, but again, the industry is changing so quickly, such as technology industry, then that assumptions might change over time. And your assumption now would be totally wrong.
Right.
And so that would completely screw you over in your valuation.
Well, so think about it this way. If you come in and you say that a company let's talk about Macy's, because we like to pick on Macy's, right? If we made the assumption that Macy's is going to grow their cash flows by 15% a year, right? And it's easy to say, well, yeah, if their current stock price is around $30 a share, $35 a share. Yeah, they're worth $120 a share. No, because they're not going to grow at 15% a year, right? That would mean that they would double their cash flow in 5 years. There's no way that that's happening. In fact, you would make the argument that their cash flow is declining, right?
Yeah.
I mean, because they're shutting down stores and trying to maintain the profitability that they had.
Yep.
And maybe they can. Maybe this is a short-term trend. I don't know. Maybe the online stuff will take over. That's something that you have to analyze and see. But if you make your assumptions be you put a very low discount rate or you put a very high growth rate, what will end up happening is you can easily say that this company is cheap when they're not.
Yeah. Yeah, you really, really easily fool yourself with this.
Yeah.
Because I know, this kind of cash flow, you can easily Google this kind of cash flow spreadsheet or this kind of cash flow calculator. You'll find, pretty complex looking Excel spreadsheet, and you're sitting there plugging in numbers, and then boom, you get a number at the end, and that seems very sophisticated and everything like that. But really, you can really fall into this trap of making all these assumptions that may not even come true and may be completely false. Well,
and the danger also, I think that I've heard a lot of people say this, because I live in an engineering world, right, with software development and things like that, is we could just automate discounted free cash flow for every single company and then return a number and then just use that to automate our investment strategy. And what I would say to that is, if you're going to do that, prepare to lose money, one. Two, you can't think that way. Investing is art before science, right? And so if you start using spreadsheets and automated, algorithms, right? Because let's be honest with ourselves, right? If you're that lazy that you don't want to do this, like you could think you can automate all of your workflow away, what you're going to find out is you're going to miss lots and lots of deals, or you're going to have to invest in hundreds of companies just to make any and then you'll diversify away any of your benefits, right? Good deals are rare. Good deals are obvious, and when you start using spreadsheets and things like that, you're missing the point of this kind of measurement, right?
Yeah.
It's Warren Buffett doesn't use a spreadsheet, and I think he does everything basically in his head, and that means that he's using simpler math. He's not using growth rates of 7.3%. He's using estimates, and those estimates are conservative, I would imagine, and so on. So when you start doing this, if you look for a spreadsheet, maybe that'll help you understand the concept, but you shouldn't be using that for evaluation. You should be able to think about this more holistically, I think, and use rough estimates of what a doubling and that kind of thing will be.
Yeah. I think something that you said right there, and something that you told me early on in my investment career, is if you find yourself sitting away, chugging away numbers in an Excel spreadsheet, then stop right there, because that is not a good investment.
Yeah.
A good investment has to be obvious, and this kind of cash flow has to be really obvious. If you find yourself doing that, could reconsider your investment thesis.
Yeah, because let's be honest, if changing the growth rate from 6 to 7% is the difference between investing and not investing, that means there's no margin of safety in that investment, right? And that's very, very important to understand, right? There should be significant margin of safety at a conservative growth rate to even, to consider this, right? So that even if your estimates are slightly off, you're still not going to lose out, right? That's kind of what you should be thinking about when you do this.
Because you are going to get your assumptions wrong.
Yes. Your assumptions are going to be wrong.
100% of the time.
Yeah.
Yeah.
So even if they are, but what you want to be doing is getting vaguely right rather than exactly wrong, right? And that's kind of the thought process you should be thinking about, is my discount rate shouldn't be exact, right? I mean, it can't be exact. What do you know you can't measure that, right? And so you should be thinking more along the lines of, what is the number that are reasonable and conservative in my assumptions?
Yeah. Yeah. So we talked a lot about discounted cash flow in this episode. You know, there's a lot of good benefits of using discounted cash flow, and there's some cons there also. But along with other valuation measurements we talked about, it's always good to take all these measurements, all these ratios with a grain of salt, because, like Hari said, investing is is a lot more of an art than science. So take that into account when you're digesting and trying to understand these different ratios and using it in your investment process. Okay, anything else you want to add here in this episode, discounted cash flow, Hari?
Yeah, I think just in episode 32, we'll go through the formula, and it may be worthwhile, if you're driving right now, to go and when you get home to actually download one of these, Excel spreadsheets just to understand them, so that you can see that when we look at this next episode, because it'll, it's hard to describe a formula over audio, but it may be worthwhile just to play with it and understand what are the kind of inputs and outputs.
Yeah.
And, some people will include, ask you to put in like multiple growth rates, like the first 5 years, what is earnings going to grow in the next 10 years, the next 5 years after that, and then what is a terminal growth rate, and all of these other things that we're going to talk about. So it may be helpful just to preload your mind with some of these concepts, so that you see them once, and then when we talk about it next time, you'll understand what they are.
Yeah, very, very good point. Okay, we will see you guys on the next episode. Thank you all for listening. Episode 31. Thank you.
Thanks.